Indranil Pan, Chief Economist at the Yes Bank. Today we heard the first monetary policy statement of the Reserve Bank of India for the current financial year. The expectations were solid in terms of a 25 basis points rate cut, which the RBI delivered. Furthermore, the RBI actually changed the stance of the monetary policy from a neutral to an accommodative position. What it clearly signifies is that the RBI got more dovish with its monetary policy, and it was clearly explained by the governor that accommodative necessarily means that we are not looking at any rate hikes in the near future. Either the RBI stays on a pause or the RBI cuts. What's the explanation that the RBI provides behind this policy stance? Number one, inflation is the most important metric which determines the monetary policy direction in the Indian economy. And very clearly, monetary policy statement acknowledges the fact that inflation has actually come down quite significantly, with food prices having come down due to a huge downward shift in the vegetable prices. What was also explained is that the Rabi and the Kharif crops are good. Second, advanced estimates of the agricultural production points to a healthy agricultural production in the country, which is also enabling a lower shift in terms of the food inflation. On the other hand, the policy was set in a context of ever-growing global distraught with respect to the Trump's tariff, and the broad consensus that is building is a downshift in the global growth. In fact, a lot of commentary is now talking about a US recession, and there could be possibilities of increases in inflation simply because of supply chains getting distorted. But as we sit today, we have seen a significant drop in the crude oil prices. Crude oil prices actually came down overnight from around $75 a barrel, I'm referring to the Brent crude oil, to about $60 a barrel. Global commodity prices, industrial metals have also been coming down, which also provides comfort to the domestic inflation. Therefore, broadly, in terms of the forecast, the RBI reduced its inflation forecast from the earlier 4.2% to a 4%. Indeed, our forecast is slightly lower than this, but taking into consideration RBI's forecast of 4%, there appears to be more room in terms of interest rate cuts. But before going there, what we want to indicate is that the GDP growth projections of the RBI has also been brought down from an earlier 6.7% to a 6.5%. And even though risks are stated to be balanced, we think that the risks in terms of the downward bias in terms of the GDP could be slightly elevated given what is happening in the global space. Given all this together, we think that there could be space for the RBI to reduce monetary policy rate or the repo rate by a further 50 basis points, bringing the terminal repo rate to about a 5.50%. What it also does for the consumers is that as the transmission takes through, because of the liquidity surplus in the economy, we are hoping that there would be a better transmission of the current monetary policy reduction compared to the last one that was done in February. And as the transmission takes through into the system, we should be seeing better appetite in terms of consumer demand for loans, and therefore a stability in terms of the economic cycle. To sum up, growth and inflation expectations were both brought down in the current policy from 6.7 to 6.5% for growth and 4.2 to 4% for inflation. Going forward, we should see another 50 basis points cut in the repo rate with maintenance of adequate liquidity in the system, which should help transmission of the monetary policy signals into the economy. Thank you very much.